It's time to get pre-qualified. Welcome to my home buying process series with Jana and May. Kick back, hit like, and subscribe to my channel and hit that little notification bell so you will be notified whenever a new video comes up on Thursdays. Last week we covered choosing the right realtor to help you buy your house. In this video, we're going to talk about getting a mortgage pre-qualification. I have invited Mann, who is a loan originator with Trustmark Mortgage, and he is one of my preferred lenders. Without further ado, I would like to introduce you to Mann to answer all your questions about obtaining a mortgage pre-qualification. Michael, thank you so much for joining us today. You want to tell us a little bit about yourself?
Yeah, sure. I'm Michael Mann with Trustmark Mortgage, mortgage loan originator. So I do a pretty fair amount of business in all the loan programs you could probably think of. So well versed in pretty much anything you may want to do when it comes to purchasing a residential home. So I'm here to help.
Thank you. And you're in Birmingham, Alabama? That's
Yes.
right.
Mm-hmm.
What areas do you work in a region? If someone wants to contact you out of state?
I generally, most of my business is from North Alabama on down through Central Alabama. I do a lot in Huntsville, Birmingham, Shelby County. So that's the main areas that I focus on.
Awesome. Thank you. And I say awesome too much anyway. So how important is it for a home buyer to get pre-qualified before they start shopping for homes?
It's real important. I a lot of times use the analogy of not being pre-qualified before you shop is kind of like if you were to go clothes shopping and don't know your sizes or how much money you have. You're just kind of left, not knowing if you can afford what you want or not knowing if you may be able to actually afford more than you think you can. So it's very important to go ahead and have that part taken care of so you can go out and shop and know what your possibilities are.
Absolutely. When looking for a lender, how does one go about that?
Well, you want to, talk to your real estate professional that you're working with and see who they've worked with before. Because if they're referring you to someone, it's because they've worked with them. They know how their processes are. They know that they follow through. So it's always good to heed their advice because they do this all day, every day, and they've already weeded through some of that. It's important. I think it's important to go, local. There's lots of times where you run into situations where, being able to possibly meet somebody face to face can overcome some hurdles that you may not have thought of. And someone that's got a diverse product line. You don't want somebody that's only got one or two products that they're trying to fit everybody into. You want somebody that's got an array of products, so it expands your options. You may be able to actually buy a home with a lender that's got a wide variety of products, whereas if you're dealing with a broker that's only got a couple product lines, they're not going to be able to help you in some situations. So starting with somebody that has a wider range is going to give you a little bit more leeway.
What about fees? And when shopping fees for a lender?
It's always good to look at fees from one or two or more lenders. Where banks really compete is going to be in the bank fees, the origination costs and charges, appraisal fees, things like that are specific to the lender. When you're looking at fees a full list of fees, you're going to see a lot of things that are strictly estimates. Regardless of what lender you end up going with, those fees are going to be the same. So they're not really competition points where you're going to be getting the best deal by comparing, say, title fees on one lender's estimate versus title fees on another lender's estimates, because those aren't specific to the lender. You want to make sure you focus on the fees that are bank specific, and that there's not anything being built in or being made to look better by, our title fees are lower, because those aren't the bank's fees. They don't control them.
Right.
So
That's a set amount. I got you. Thank you. So you should ask for a good faith estimate whenever you speak to a lender, and you have 30 days to shop for lenders without it starting to ding on your credit.
Yeah, and the terminology has changed some over the years. Sometimes they're will be called a loan estimate. Sometimes they're called a fee worksheet, an initial estimate. But those things that will actually break down the cost, payment, interest rate, all those things, you want to be able to compare those.
Exactly. So, after selecting a lender, what is the process of obtaining a pre-qualification letter?
Well, first we have a conversation to get what the buyer perceives their buying situation to be. And it's always different for each borrower. Some borrower or buyer, some know exactly how much they want to spend, how much they can afford, what their credit score is. They've been through it before, or they've done their research, and they've got a really good idea. Some, on the opposite end of the spectrum, have no idea. Don't know what the credit score is, don't know what the budget is. So we'll have a conversation to kind of feel those things out before we get all the way into the area of pulling credit and getting income docs and things like that, just to make sure that it's the right time to do that. Once we've determined that, yes, so there's, based on what the buyer or borrower knows about their situation, it sounds like we're good to go ahead and pull credit, start reviewing income and things like that. So that's, at that point, we'll start an application process and start working through products and see what matches up for everybody.
So what's the difference between a pre-qualification letter and a pre-approval letter?
So a pre-qualification basically is me saying that based on, I will have pulled credit and we will have at least discussed what your income is, and I will have had to get some sort of comfort level at least with what your income is. I may ask for documentation of it, assets as well, and that all kind of depends on how that conversation goes. And I can pre-qualify you based on having reviewed your credit and having discussed or reviewed your income and asset documentation. And I can issue a letter that says you've been conditionally pre-qualified to go out and shop for a home. Pre-approval means we've had that conversation. I've collected all your documentation that you would need aside from a property address or a contract, and actually had an underwriter review your file and give a conditioned approval pending an appraisal of the property. So that at that point there's an actual pre-approval. It takes a little longer to do that because it's got to get through the pipeline to an underwriter. They've got to review the file. But pre-qualifications, we can do those typically same day.
Awesome. And loan products. There's conventional, there's FHA, there's VA, there's USDA, and there's, I know, a plethora, but those are the main ones. Conventional, how much do you have to put down for a conventional loan normally?
Depending on a couple of things. I mean, it can be as 3% in certain situations. Typically it's 5% or more. If you're a first-time home buyer, or there's certain income limitations or areas where you may be able to do a 3%, but most cases it's 5% or more. If you're doing less than 20 on a conventional, though, there's going to be mortgage insurance involved there, but on a conventional loan, the mortgage insurance on those is temporary. It's not a permanent unless you pay it all up front. But if you're paying a monthly mortgage insurance premium, you can have that come off once you've gotten to a point where you have 20% equity in your home. Whereas some other programs, that mortgage insurance may be permanent or have different guidelines for removal. But that's the one of the bigger differences from conventional.
Is the PMI the same? The mortgage insurance the same on conventional, on all products? The mortgage insurance, or does it fluctuate depending on the lender?
Well, it depends on. So mortgage insurance is it's actually a third party you're paying a premium to insure that loan. So the lender will actually get quotes on your behalf from different mortgage insurance providers and help select the most cost efficient one. So we've got several mortgage insurance providers that we can go to on conventional. FHA is different. That's a standard mortgage insurance amount. USDA, VA, they all kind of have their own guidelines, but conventional, you can shop. We can shop that insurance for you.
Thank you. So FHA, explain what FHA is.
It's a government loan program. Requires less of a down payment typically. In general, lately the rates are a little lower on it, but the mortgage insurance could be higher. So some of that kind of washes out. 3.5% down payment. So it could be a little less than the conventional. In a lot of cases, it allows for maybe lower credit scores or higher debt to income ratios in an FHA loan. So there's always certain factors that would guide us to an FHA loan out of the conventional world into an FHA for different reasons. You know, somebody could qualify for a conventional, but FHA is a better deal for them. So it's not necessarily either or. There's kind of some middle ground for those.
VA is for our veterans and our military. Do you want to talk about the VA loan? And
yeah, VA
because
is
there are people who qualify and they don't think they qualify because they're not an active member, et cetera.
Right.
Or they didn't do like 10 years in the military.
Right. So. Yeah, there's actually very few situations that I've come across where an active military or veteran borrower has not been eligible. There are situations where they're not, so that it's something we have to check. But it's another 100% program. The rates are typically great on a VA loan. Timelines are a little different. We usually have to give a little bit more time for a VA loan. We do our part, and then we have to send it to the VA, and they do their part. So there's a little extra time as far as getting it all wrapped up. But very forgiving, I would say, when it comes to the debt to income ratio. And like I said, rates are great. No down payment required. It's just if it's something you're eligible for, it's a great process.
So with USDA, that's another government loan. You want to talk about USDA?
Yeah, it's a loan that allows you to borrow up to 100% of the sales price. It has its own different credit score requirements, but it also has limitations based on location and the area that the home is in, also income limits. So there's a couple things we have to look out for when we're looking at a USDA loan. One is the property itself qualify, and is the family living in that home, is their income fit the box for USDA, because you have to be under a certain income limit for that area in order to do a USDA loan. And we've got some portfolio loans also that are, and portfolio loan is a bank product. It's a Trustmark bank loan. So it's not an investor loan. It's not an investor loan backed by FHA or USDA or something like that. It's our loan. And we have different portfolio programs, but some of those go up to 100% as well. And they'll have income limits also, and area restrictions and things like that. So it's not the same as USDA, but it's kind of some of those same guidelines that we have to stay within to do those products.
Thank you. After you receive your pre-qualification letter and you've chosen your loan product, now it's time to go home shopping. And that's when you call your realtor and start shopping, start looking,
Yeah.
start having some fun.
That's right. And I'll typically will ask my my borrowers that as they're out shopping, if they, when they come across a property they like, I'll have them send me the address. So while they're out looking around, I can go ahead and pull some information on that property, see about talking with somebody, an insurance agent, if they've identified who they want to use, talk to their insurance agent, see what kind of premium they may be looking at on that house, pull tax records, see what that amount is going to look like for them. That way, by the time they decide if they want to make an offer on it, we can already be able to give them an idea of what kind of payment they may be looking at. Sometimes we'll pull it up and the house wasn't homesteaded before, so their taxes are higher than expected. So we'll have to let them know pretty quickly, hey, just keep in mind the taxes are higher on this property.
Which can affect the debt to income ratio, right?
Correct. Yeah, so that's why I always want to know if they're looking at a property, if they're kind of in a gray area on qualification. I'll really let that buyer know, hey, shoot me an address before you contract on it so we can look at it. So even after the pre-qual, before a contract, I still like to stay in touch during the shopping period. So we still kind of manage those ratios, before a contract is made.
And even a floodplain, if the property is located in a floodplain, the flood insurance could mess up your debt to income ratio. Do you want to explain debt to income ratio?
Yeah, it's one of the main factors in qualifying for a loan. It has to basically, it's your monthly debt versus your monthly income, and that monthly debt is credit debt. So anything that shows up on your credit report as a monthly minimum payment, auto loans, credit cards, lines of credit. It's not talking about your utility bills or how much you spend on gas every month. It's just your credit debt and this new proposed mortgage payment. So that's a ratio versus your income. And all the loan programs have different limits on that. A conventional right now, you can't go over 50% debt to income ratio. I've seen FHAs done up to 57. USDA likes you to stay under 45. So it's just our portfolio programs, 43. So it's all different limits on what that debt to income ratio can be. So that's another thing we have to keep an eye on. If you're in a conventional loan and we've qualified you with a 49% debt to income ratio, and we get into an area where taxes are starting to go up, or like you said, now there's flood insurance, then we have to kind of reevaluate and make sure we're not getting pushed out of that debt to income ratio where we may have to look at a different product. So that's something we have to keep an eye on throughout the process.
So we are a week away from closing. Everything's cleared, done. We're ready to count our sleeps until we get to the closing table. What's happening on your side?
All right. So on our end, we're clear to close with closing department. We're clear to close with underwriting. So on our end, the closing department is working with the title company and the closing attorney to prepare everything for the closing. But also we've got credit monitoring going on. So it goes on from the beginning of the process all the way until you're closing and funding, to make sure that you're not obtaining any new debt that may change your debt to income ratio. So you'll want to keep in mind throughout the process to be careful not to do anything new credit-wise. No new credit cards. Don't go out and buy a car. Don't go to the furniture store and finance a bunch of furniture.
Or a
because we're going to get
refrigerator, or yeah.
right.
I tell my
Because we're gonna get a
buyers,
notification of that.
yeah, I tell my buyers, right when they make an offer, do not finance anything over $100. Do not charge anything over $100 without checking with your lender first and getting their permission,
Right.
because
Yeah.
I've heard horror stories. It's never happened to me because I'm Mama Bear and I'm all up in it, but involved. But yeah, where people went out and financed their a washer and dryer, and
Yep.
it took them over debt to income ratio, and they couldn't close.
Yep. 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 It happens. It definitely happens. So
Pardon me.
it's important from the loan officer side to address that with them. The great realtors that I know, like you, address that with them, because once you've seen it burn somebody one time, you don't ever want that to happen to somebody again. But we
Horror
do. We get
stories is all I needed,
Yeah.
just to hear the horror
Yeah.
stories.
Yeah, if your credit is run, we get a notification, and then we then have to reach out to you and find out why your credit was run, what the result of it was, what's that new payment that you took on, and if it messes the debt to income ratio, even if we're clear to close, it can turn the deal south. So important to not do that.
Very, very important. Michael, thank you so much for taking the time. I know you're very busy right now. And if you'd like to get in touch with Michael Mann with Trustmark Mortgage, what's the best way?
Cell phone number. I'm always on my cell phone. I actually even have my office number ported to my cell phone. It's the 205-617-4787. Or if you just want to shoot me an email just to set up a time to talk, it's mmann@trustmark.com. So either one of those works great for me.
Thank you so much. You're awesome. I hope that gave you a head start on getting a mortgage pre-qualification and all the steps it takes to get to the closing table from the financing perspective. And if you enjoyed this video, please hit like, subscribe, and that little notification bell, so you'll be notified every Thursday when I upload a new video. And if you miss episode 1, it's right here.